Let's dive into a simple but really powerful idea from John Bogle's The Little Book of Common Sense Investing. It's an idea that, honestly, kind of flies in the face of the entire financial industry. And it all boils down to this one paradox. When it comes to your money, doing less can actually make you so much more. So, how does that work? Let's get into it. Warren Buffett absolutely nailed it with this one. He said, for investors as a whole, returns decrease as motion increases. Just let that sink in for a second. That one sentence is basically the key to this whole explainer. It's suggesting that all the activity, all the trading, the stock picking, the constant shuffling around that we're told is so important might actually be the very thing that's holding us back. So here's how we're going to tackle this. First, we'll talk about why investing should be a winner's game. Then we'll use a little story about the Gotrocks family to see where things go off the rails. From there, we'll get into the nitty-gritty math with the tyranny of costs, pull back the curtain on a grand illusion, and then finally land on the beautifully simple common sense solution. All right, let's start with the basics. Investing in the stock market, at its heart, is not about gambling. It's about owning a piece of real businesses that make real stuff and provide real services. And that is a fundamentally positive game to be in. Okay, think of it like this. You got two games you can play. The winner's game is incredibly simple. You own a small piece of every great business, and you just collect the rewards as they grow. It's a positive sum game. But then there's the loser's game. And that's the game of trying to outsmart everybody else, constantly trading and paying all these fees to so-called helpers who, as we're about to see, just end up taking a slice of your pie. And here's the crucial thing to remember. Sure, in the short term, stock prices can feel like a total popularity contest, driven by hype and emotion. But over the long haul, your real wealth comes from just two things: the dividends companies pay out to you as an owner and the growth of their actual earnings. That's it. That's the engine. To make this idea really stick, John Bogle tells this fantastic little story. So let's talk about the Gotrocks family. It's a simple parable, but man, does it hit home. So picture this. The Gotrocks family owns 100% of all the businesses in the entire country. That means they get 100% of all the profits. Perfect, right? Simple. But then some clever helpers arrive. First, brokers convince the family members to start trading stocks with each other. And of course, they take a little commission on every trade. So the family's pie shrinks a bit. Then money managers show up, promising to pick the best stocks for a fee. The pie shrinks again. Finally, consultants arrive to help pick the best managers for yet another fee. And by the end, the Gotrocks' share of their very own pie has been seriously eaten away, all because they paid a bunch of outsiders to play a game against themselves. The Gotrocks story is a great illustration, but it's not just a story. It's based on what Bogle calls the relentless rules of humble arithmetic. So now, let's look at the cold, hard numbers behind it all. Okay, before you factor in any costs, trying to beat the market is a zero-sum game. Simple as that. For every person who wins, somebody else has to lose by the exact same amount. It all cancels out. But the moment you introduce costs, fees, commissions, anything, the game changes completely. It becomes a loser's game. It's a mathematical certainty that all investors, as a group, will underperform the market by the exact amount of costs they pay. There's just no way around it. And this is what that math looks like in the real world. Check this out. If you invested $10,000 back in 1980, the market itself would have grown it to a profit of over 179 grand. A super low-cost index fund would have gotten you almost all of that, about 171,000. But the average managed fund, after all their fees and costs, just 98,000. I mean, that difference is just staggering. That's over $72,000. And that money didn't just vanish into thin air. It was transferred, plain and simple, from the investor's pocket right into the pockets of the financial system. That is the price of playing the loser's game. This isn't some new, complicated financial theory. Justice Louis Brandeis was quoting ancient wisdom 100 years ago, and it's truer than ever today. This is just about simple, undeniable arithmetic. But believe it or not, the story actually gets worse. The math we've just seen is hiding an even bigger problem, what Bogle calls the grand illusion. Turns out the return a fund says it got is often very different from the return its investors actually experienced. Yeah, as bad as that gap from costs looks, what if I told you that for many people, the reality is far, far worse? Just look at this. For a 10-year period, these aggressive growth funds reported a pretty solid annual return of about 7.8%. Not bad. But the average investor in those exact same funds actually lost 0.5% every year. How is that even possible? Well, it's because we humans are really bad at timing. We chase performance. We hear about a fund that's on a hot streak, pile our money in right near the top. And then, when it cools off, we panic and sell. We consistently buy high and sell low. So the big takeaway here is that our own behavior, our own emotions, fueled by all the marketing about yesterday's big winners, just makes the damage from high costs even worse. Chasing what's already done well is a surefire way to get left holding the bag. Okay. We've laid out all the problems, the costs, the behavioral traps. It sounds a little bleak, I know. But the good news is the solution is just incredibly simple. It's just common sense. And that solution is the index fund. Look, instead of trying to find that one magic needle in the haystack, that one amazing stock or that one genius manager, you just buy the whole haystack. An index fund does just that. It buys and holds all the stocks in a market, like the S&P 500, and its whole goal is to give you the market's return minus a tiny, tiny cost. And the advantages are just baked right in. First, the costs are rock bottom, which means you keep more of your own money. You get instant, broad diversification, so you're not going to get wiped out if one company has a bad year. They're way more tax efficient because there's very little trading. And the beautiful simplicity of it all means you can just stop playing that frustrating, self-defeating game of trying to guess what's next. And hey, you don't have to take my word for it. Listen to Charles Schwab, a guy whose company makes a killing on active trading. He says for the average person, he's an indexer. And why? Because the predictability is so high. You know for 10, 15, 20 years, you're almost guaranteed to beat the vast majority of professional money managers. His last question says it all, really. Why would you screw it up? And really, that's what it all comes down to. When you look at your own investments, the fees you're paying, the moves you're making, you have to ask yourself, are you playing the winner's game of simply owning businesses and letting them grow? Or are you stuck in the loser's game, paying a fortune to try and beat a market that's already stacked against you? The humble arithmetic, it seems, has already given us the answer.